其实我跑的就是因为细分层特殊的难题，特殊。
All right, good morning, everybody. So we're still range bound in Brent. There was a post that came out that Goldman's calling for a spike in oil. If we get that, it will add to inflation. So it'll kind of knock back that lowered inflation expectation. So it's something to consider. Asia closed with another indecision candle, although the argument could be made that it has started to roll over after that doji candle from Friday closed down on the day, but still within the previous day's range. On the FTSE 100 for Europe, we do have an inside day breakout, and it's expanding to the downside reasonably well. You know, we got a Marbozu at this point, a bearish Marbozu. Going to look for that to stabilize. If it closes in the range, then it's just another day, right? It's a yawn, no biggie. If it breaks to the downside, then we could, have that discussion that it might be something more. So far, whatever it is that's going on in Europe, and I'll show you in just a minute what that is, it hasn't bled over into our markets yet. So what's going on over in Europe? They had one of their members from the ECB calling for 50 basis point rate hikes for the next 4 meetings back to back. And that did it right there. I mean, that was the cream of the crop. So market didn't like that, down it went. That little bit about oil came from right here. So we do have Powell this week, Tuesday and Wednesday. Usually it just kills the morning session. There's a market waiting for him to screw up. And if he manages to thread the needle operation don't rock the boat, doesn't say anything extreme or stupid, blow the market out of the water, then it finishes the rest of the day with whatever else happens to be going on. So it's a little funny. If he doesn't say anything, then everything just, toe the line. But it's almost like waiting for a car wreck. That's going to be 2 days of this week. But the big deal is going to be at the end of the week, the job numbers. Make no mistake about it. This is going to be impactful to the market. Now, to put that into perspective, I'm not saying it's going to be a big volatility event where price is going to make a big sweeping move up or down like 5 or 6%. It's going to change the dynamics and the structure of the market. So job numbers are Friday. We're going to start getting those numbers on Thursday, but the big report is going to be Friday. Where even Wednesday, we got jolts. We also have important auctions between the 10-year this week at lunch and the 30-year this week. Those are two big ones, really worth paying attention to. For today, we just have the 3-month and the 6-month. It's the front end of the curve, like the IRX. We can see volume is light today, not concerningly so. It's in the lower range of around 100 for the cumulative overnight volume. That's about right. It's a little light, but it's okay. Right? Below 80 would be concerning. We got a really narrow IB, and then we popped up out of it. And now we're right back down into it again. So the IB is the initial balance. It's the first 1 hour when we open up at 6 o'clock. Now in more recent times, there's been people who reference the IB from the RTH open starting at 9:30 and going until 10:30. They're not wrong necessarily. Just when initial balance was first kind of conceived, it was done using Globex, right? And it's just the way that it's always been done, which doesn't make it right or wrong. It's just somebody changed it along the way and said, why don't we just use RTH data? If it works, then sure, why not? I don't use it, but you could, I suppose. What concerns me this morning is this high that was set last night. Wow. On the first spike, this creates a liquidity vacuum. We've come back down. We've, closed the gap, resolved the vacuum. But now we've got this unresolved top that really needs a visit. We don't have to go back to it. It just seems like unfinished business. So whether we dump or not, whether we, break out above that high or not, I would still be looking for an early trend line breakover and a retest of that 40.62 area. Just keep in mind with Powell on deck Tuesday and Wednesday that, we're probably going to get pretty sideways market, at least in the morning, right? In the afternoons, can be a whole different thing. There have been times where we get that reversal that I talked about last Thursday and the follow through on Friday, and then another follow through after that. But they're rare, right? Getting back to back 3 in a row, 4 in a row in the index is not so common. So just something to kind of keep in mind, right? Almost like it's due a doji or a spinning top or a little bit of a pause candle or a neutral candle today. One thing would be really worth marking out is 50% of last week's candle. Because we kind of really need to stay above the 50% mark on that weekly candle if we're going to maintain our bullish bias. 10-day, 30-minute volume profile. We are above the point of control, and we've moved to the upside with relatively little abandon. You can see that these volume structures on the left haven't really slowed it down or stopped it at all. They're nearly insignificant after working through all of this trash from back here. And we do have a classic head and shoulders. If you were to measure the neckline break, take it down to the head, you can see that we got to 100% of the move. I know it says 200, but 0 to 100 in the label is what we measured. So it's taking 100% of that, setting it up there. So it says 200 only in a label. It's 100% of the move. Wedges, head and shoulders, flags, cup and handles, all of these things that we measure, 100% is like the end of the line. It's all that it owes us. So 50% is the first target. 100% is the target. It's the end. We don't really use 150 and 200 on patterns. So this head and shoulders is done. We wouldn't want to focus on it anymore to get any sort of bullish bias or targets or anything like that. So I mentioned the TRB this morning just to come up and close that, resolve this top up here, which really feels like unresolved business. But there's a bigger trend line. And we're just starting to kind of work through it. Now, I'm not on the right time frame to really, snap a good clean trend line, but that'll do it. It just gets the point across. The longer we go sideways, the more this idea that the trend is done and price will break through the trend line. Or we pull back steep enough and we break through the trend line. Either way, it's destined to break through the trend line if it doesn't get back into gear and start going again. Once it breaks through the trend line, then we'll be looking at a topping pattern. It changes the dynamics a little bit. Mapping out the 5x5, we've already crossed through the point of control of yesterday, so there's no VPOC to carry. We do have one overhead, 4107, and we got one underneath this 3946. But we really don't have much to go with here. It's interesting to look how price responded at these levels. right? I know it probably is hard to see these levels in the stream, but I've got these kind of like ghost lines, CPI high, CPI low. They've been on there for a long time. And we can see from the volume profile how price responded at these levels and where the orders were at. Now we would have to turn on a TPO chart to figure out, did we come up into those like a ceiling and hit that? Or, did we get there and then get a balance, like a base, where there was two-sided trading and just a lot of trading activity done in a short period of time? I had put out a warning on Friday, don't short this thing, just because it seems like it had got too high, right? It's some general curse. So we were gapped up pretty strong in the pre-market. We get up at the open and we get an explosive breakout, kind of pauses at lunch. I think that was the time for my warning. If not, it was on the next batch. Don't short this. It's just going to cause another pop. Don't short it again. It's just going to cause another pop. So every one of these, everybody tried to pile in and short it. They get squeezed. They add to the buying because you have to buy to close a short, and it pops us. Rinse and repeat. Everybody starts to short. They get squeezed, it pop, push up again, and then again, and then again. And it'll just keep doing that as long as everybody continues to try to short it. They just keep getting squeezed and popped. Hopefully you were long through that. And at the very least, you weren't trying to short it. So there's not really a precedent for a third day. I've learned long ago to say that, not to say price can't do it. There's an example from back here where we had 3 days in a row with the red to green reversal, the whole thing. So it can happen. I just wouldn't count on it. 4086 is going to be a level of concern to focus on today. Also, the ADR has declined even more. It's down to a 1.5%. Pretty cool. So our daily range is getting smaller and smaller. In the grand scheme of things, this means a lot, right? It's a perspective on volatility. Since COVID, the market has been violent and extreme. Big candles, big moves. We overshoot targets. We overshoot levels. Lots of reversals. It just makes it harder to trade. And a lot of new traders who've never traded in anything other than a after COVID market haven't seen anything else, don't know that there's another kind of market out there. We're going to look for the ADR to eventually get back down to about 0.7. So another 50% less than what it is right now, at least. If we break our Globex low today, somewhere around that 40.40, we're going to look to revisit these levels from Friday with little speed bumps along the way, right? 40.37, 40.30, 40.17. The cash open from yesterday, the RTH low of yesterday at 4,000. And then we'll deal with the entire low of yesterday, about 39.75. I don't expect to retrace the whole thing if we break our low today, but it's certainly possible, right? Instead, about half of that would make more sense. All right, yields are still backing off, which are nice. That's going to help the market, or at the very least, not hold us back. Bonds, they got that defense that we had talked about last week. Right now, they got to get back above that 102.35. Call it 102.50, right? Kind of line in the sand. And here in the pre-market, we can see that we're doing that. So that would give us a breakout of this entire structure. It's another form of a TRB, classic double bottom designed to trap bears and then spring the trap and explode higher. It's exactly what a double bottom is supposed to do. And they did a really good job on it. That was a nice trap. Thankfully, I pointed it out Thursday, so you didn't try to short it and get trapped. So we need that follow through here. At the very least, it needs to hold the line and not fade back. All right, they came in and defended the market Thursday and Friday. It's part of that boost that we got. If they let off, I think we're just going to fade right back down again. There's a difference between, the momentum that you get and inertia. We really don't have anything in VIX. It's still broke. The CBOE was talking about what they could do on this, and what they finally came up with is we're not going to do anything. And at first, I was kind of surprised by that, but looking at it from their point of view, if they responded every time it didn't work correctly, they'd be changing this thing constantly. There's a reason it's not working correctly, and that's because everybody's trading in the front end of the S&P, right? Those 0-day options. Well, it's not like we haven't had 0-day around for a while. It's been around for a long time. We just happen to have them now 5 days a week in the SPX. Their argument is the institutions really don't have anything to hedge, so they're not going 30 days out and hedging. They're just trading in the front to, make money on the volatility of the P&L volatility of a short-dated option. So their argument is once market-making firms or the institutions, they, them, and those guys Once they start buying up a bunch of stuff, that stuff that they've bought needs to be hedged. They will instinctively start trading farther out on the date curve, and the SPX 30-day options will get traded and the VIX will work the way it's supposed to work. So the only reason it isn't working right now is the firms really don't have anything to hedge. They'll make money on a short, so they don't need to protect the market from going down. Makes sense. So we can reverse that and look at the VIX as a signal for, are the institutions loading up to go long again? Because maybe you would want to load up and go long again in your longer term portfolio, your buy and hold longer term accounts. I continue to get asked the question, do you think it's safe to start buying again? I mean, it's been safe to buy all along, as long as you're willing to hold through the pain. If your plan is a 20-year plan, you could buy it today. It wouldn't matter. 20 years from now, we're going to be in a different spot than we are now. But if you're looking to time it and kind of ride some sort of swell to the upside, maybe just keep your eye on volatility. Because if they start trading farther dated SPX options to hedge, that means they actually have something to protect. That's right, it doesn't. And that's the whole point, right? The VIX doesn't include 0-day options. And that's why the VIX isn't responding to the market the way it's supposed to, or the way that we would expect it to, because everybody's trading in the front. So when they quit trading in the front and start trading farther dated options again, the VIX will start working again. And when the VIX starts working again, it's going to be a signal that they actually are carrying something now that needed protection. And that means they're long again. In the meantime, there are different volatility tools that exist that can help you kind of gauge what's going on in volatility in the short term. And one of those is the VIX 9. Just like it sounds, it's a 9-day VIX. The regular VIX is a 30-day VIX. Then there's a 3-month VIX, a 6-month VIX. There's a 1-year VIX if you want one. So VIX 9-day, it's very short duration. It doesn't work in the pre-market, but during the day, it's a pretty handy tool. All right, so there's that. Yeah, their answer was, we're not gonna fix it. That they don't want to break it. They said it ain't broke. When people start hedging, it'll start working again. And it makes perfect sense, if you look at it from that point of view. There's also the VIX futures. Can use that. And then there's things like UVX. And there's literally a ton of these different things out there. The Russell has its own VIX. Gold has its own VIX. Oil, bonds, precious metals. There are particular VIX structures for things like Apple, Microsoft, and it's not implied volatility that I'm talking about. It's using the VIX formula, the 30-day VIX formula, and instead of applying it to the SPX, you apply it to gold or oil or Apple. If you were to go out and Google, Apple volatility, you would probably find that obscure, weird chart, right? I don't think it's something that you can get on Thinkorswim, but once a formula is developed, you can apply that formula everywhere, anywhere, and people have. So something to think about. when it comes to volatility, you have a lot more choices than just the VIX. We'll say it that way. A long time ago, I did 20 videos on volatility, literally a volatility school. I could do another 20 videos and we still wouldn't have covered everything about volatility that there is to cover. There's just so much stuff. The main thing is, even though the VIX necessarily isn't, a very useful tool right now, the fact that it's not useful is actually telling us a lot. And when it does begin to start responding again, that means that the institutions and the firms are actually hedging something again, that they bought enough of something that they need to cover it with protection. It's kind of like having insurance for a car. If you don't have a car, you don't need the car insurance. So why buy it? So Trade Flash says that there's some broker action on Apple. That's all that it says. Doesn't really have much more than that. Oh, Goldman Sachs put a buy on Apple at 199. That's starting to look a little bit like a blow off top. And when we see, that's going to be a nice shadow print. When we see a rise up like this in the pre-market with a whole bunch of analysts coming out all at once, trying to actually do their job, that's usually because they got poked and were told, hey, go write an article on this, kind of pump it up a little bit. So, I mean, it's a nice pre-market rally here. And it closed this gap at 152.55. There's another one at 153.71, and it's almost to that one too. And that will put Apple back up into this structure with a lot of liquidity up here. NVIDIA's got a market maker move this morning of over 3%. And Tesla's got a market maker move. Facebook is about to break out of Friday's high. At least it's certainly trying. With Facebook, we've got that earnings high to focus on, and a lot of wicks up there, a lot of liquidity still left. So the fangs are rallying into resistance this morning. Kind of keep that in mind. Nat gas down 11.5. Yeah. So we're revisiting 8.74. That puts us underneath this white line down here. I mentioned last week that it wouldn't surprise me if we build a structure down here. We're starting to get a little bit of that head and shoulders, but it's going to be a really wide daily head and shoulders, and it could take weeks for that to finally play out. But that's certainly a nice haircut. All right, and it was nearly perfect right on the roundy, $9.99. I mean, really close to $10. And it actually looks like it did get to 10. The China names down 1%. Same with gold and energy. Even with that call from Goldman Sachs, the energy's likely to get a pop. We're not really seeing any of the bond structure, like shy, junk. Only TLT getting a little bit of a bump down there. So we want to see more of those bonds moving to the upside. We don't really have enough of it yet. So it's a really flat market out there. I mean, we got nothing for the NASDAQ, down 0.5% and up 0.5%. We got negligible numbers, just barely registering at all. Same thing with the S&P. So it's kind of an odd way to start the week. We are scattered all over the place. There's no central theme. There's nothing to grab a hold of. So for the FANG names that are down, they're not really down all that much. Less than 0.25%, which really just kind of, if it's less than a half, then I really don't even mess with it. And I've been considering moving that benchmark to 1%. We'll still use a half. If we use a half, then it's Tesla, Meta, and Apple, and that's it. The rest of these haven't moved enough to, even give it any real consideration at all. So we've got nothing this morning. No China internet ADR plays, no Bitcoin proxy, no short squeeze on, oversold trash. I mean, you can try to do it that way, right? I wouldn't say you're wrong. Just if you're trying to use Apple and Nvidia for a proxy on when the market should fall, it almost seems like you're approaching it from the opposite direction, right? A lot of times SPY is Apple, Apple is SPY, right? I've said that like forever. So, that kind of fits the bill. But trying to turn that around and then say, okay, well, the market won't fall until Apple hits this level, or it won't fall until Nvidia does this or Tesla does that. When they were bigger, and they had more weight behind it, there's an argument that that could be. But when Tesla fell out of favor and really finally broke structure and started heading to the downside, the market didn't care. Then there's the continued argument that Apple is like the general of the marketplace. It is Wall Street's darling, and as long as it continues to hold up, the market will hold up. I mean, to a point, that is true, because if they won't own Apple, why would we expect that they'll own anything else, right? If they're seriously selling their Apple, they're going to sell everything. But that would mean seeing Apple break significant structures like 124, not just, oh, well, it went down on the week, because I mean, it went down back here and it went down back here. And you know what I mean? Like, so you could swag it. That's the going term right now. The same way that we swag it with the dollar and the VIX. But the rally up last week, Thursday into Friday, that wasn't Apple, that was bonds. They came in and defended the bond market, and that lifted everything. So, you know, do they have room to go up? I mean, yeah, as much as anything else does. What if we take Apple and stick it into the same tool that I use every day in the morning briefing and look at its distance from 10? Is it overbought? Nope. It's not overbought. So here's the last 5 years, and we can see how far Apple gets from its 10-period weekly moving average before it stalls and looks for a reversal at somewhere around 4.5% to 5%. We're only at 3% above the weekly, so we're not overbought. And then we've got this cyan line, which is the anchored VWAP for the start of the year. We're above the VWAP. This says we've got plenty of room to go. Looking at the daily 10, it seems that we don't start reversing until around 3.5% to 4%. So it's asking how far away from the 10-period daily moving average are we? We're only at 1.65%. If the average is 3.5 to 4, this says we could get a lot farther away from the 10, and we still wouldn't be overbought. So has it moved too far, too fast? No. Is it overbought? No. From either one of those perspectives, there's still plenty of room to go. But that doesn't mean that it's gonna go, right? There's a difference between, is there still room overhead to continue the upward push? Yes, there is. Now comes the argument of, do we have any expectation that this buying is going to continue? That this rotation is going to stick? We have 2 days of a sideways market with Powell sitting in Congress. And then we've got really, really, really big jobs data coming out this week. And that is going to move the market a lot more than Apple getting into a resistance or Tesla or any of the other names. I think you're on the right track, though. The idea that you're looking at NVIDIA and Apple and the other names to try to get a feel for what the entire market is going to do means you're on the right track, because most people are going to look at one name, SPY, and try to figure out what they think SPY is going to do without giving any consideration to the rest of the market at all. continue to watch the 10-year this week. We do have auctions there. Watch the news, FX Street, or whatever you do like for any additional Fed speakers. Remember, they're going to go into quiet mode. They have an FOMC on March 22nd. They go into blackout mode 10 days before, and then we'll have to watch that Nick Tamaros guy from the Wall Street Journal. He's like the little Fed whisperer. If they're going to leak anything, they'll do it through him. And we want to see any kind of language that says 50 basis points is on the table, which is one of the reasons that this week's job numbers are so critical. They were a big surprise. The market didn't like it. That was a large part of the gut punch that came, and now we're primed up for another one. It's really starting to look like all this work that the Fed has done and all of the rate hikes that they've put into the market hasn't even started to do the job that they've been trying to do. They haven't slowed anything down, and inflation is still rising. So depending on what these numbers come up with this week, you might get Apple at 160. Or it could be a new breakdown. But it'll be because of these external things moving Apple, not just happy investors bullishly grabbing a hold of Apple to run it higher. So with those FANG names kind of hopping around this morning, I would really focus on that KRE NY FANG setup, right? Really look for a divergence between these two. What we've seen a lot lately is tech versus finance, and what we need is tech and finance. Either they're both going up or they're both going down, and that gives us a market with some drive and some structure behind it. Without it, this is looking like just a choppy day with a wait and see hold pattern. And sadly enough, this could be the market for most of the week until we get into the jobs data. JOLTS is going to be a good start on Wednesday, but Friday's the big one. So that's what I got for you guys. Be careful, be safe, keep your eye on anything having to do with, targets for the rate hike and any of the data points that the Fed uses to determine if they're going to raise rates and by how much, because we're so overly hyper data driven right now that every tiny little data point is getting heavily scrutinized. Well, if you start digging too deep into the inflation discussion, a large part of it is psychological. As long as everybody believes that there's inflation out there, we're going to continue to get it. It's this mythical beast that, once alive, has a life of its own. Certainly throughout history, that's, been proven pretty accurate. So at some point, the Fed is just going to have to decide that, 4% is okay or 5% is okay. And just let it ride. I'll see y'all tomorrow.